And welcome to today's Q&A webinar covering CompStak and Savills' latest report released last month titled Industrial Space is in Demand, but at what price? Thank you for joining us. I am Jacob Thomas, a real estate analyst at CompStak, and I will be the moderator for this webinar. Last month, CompStak and Savills released their joint report looking at the transition that is underway in the industrial sector. Today, we'll learn more about the report and get some answers to submitted questions and any submitted live today, time permitting. If you do have questions, just add them in the Q&A box. Additionally, this webinar will be recorded and will be made available later. But right now, I'd like to give our speakers a chance to introduce themselves. They are Mark Russo and Ali Bowman. Hey, Mark. Hey, Ali.
Hello. Mark, would you like to introduce yourself?
Sure. Hi, everyone. I'm Mark Russo. I'm Vice President of Industrial Research at Savills. Savills is a 200-year-old company, almost headquartered in London, traded on the London Stock Exchange. My role as head of industrial research, I lead a team that tracks 56 industrial markets across the US. We produce statistics and reports, many of which are available on our website, savills.us. Personally, I've been at this for 15 years, CRE data analysis, including working on the investment and valuation side before working for a full-service commercial real estate organization like Savills.
Awesome. Well, thanks, Mark, and thanks, Jacob. My name is Ali Bowman. I'm the Director of Real Estate Intelligence at CompStak. I joined the firm about 2 years ago. Jacob and I produce content and research using CompStak's data and often working with partners like Savills. So really excited to be with Savills today and to talk through all of your questions. And Jacob will give us an overview of what we'll be doing today.
Yeah, thank you both. Today, Mark and Ali are going to be covering the highlights of their report, including effective rent growth, the upturn in vacancy rates, and a deeper dive into the greater Los Angeles market in particular. Afterward, we'll put some questions to our speakers and go over some submitted ones. Largely, thus far, the questions fall under three major themes: leasing trends, overall industrial sector headwinds and tailwinds, and the future outlook of industrial. And with that, I will turn it over to Ali.
Great. Thank you, Jacob. So like we said, we're going to give a quick overview of the report that everyone submitted questions for before we dive into the questions. And lucky for you all, since it's now the end of April, we actually took the report and updated some of the data. Previously, it covered through the end of 2023, but the first quarter has ended. So we've added new data and we're excited to share that with everyone. So, and it also turns out our timing is pretty good. Last week was a big week for industrial news. Prologis announced that they were downgrading their outlook for the rest of the year. They're starting to see a slowdown in the industrial sector. Occupiers are paying a lot more attention to what they're paying and reducing their demand. So we're happy to dig into that and what our report showed. So overall, our report showed that industrial space is still in demand, but pricing is under correction. So the first thing that we've taken a look at in our report is effective rents, which of course effective rents are a good indicator of pricing because they account for concessions, escalations, and all the different parts of the deal. So when we first started to look at this report, we really focused on the Los Angeles, Orange County, Inland Empire market. That's where we started to see a few months back that pricing was actually starting to decline. And in fact, it started to decline a bit in a few other markets or start to plateau. Here we can see that effective rents are still up from 18 to 115% since 2019 to the first quarter of 2024, but they've changed a bit in recent months. But why is this happening? This has to do with availability and vacancy. Mark, can you update us on what's been happening most recently with vacancy rates?
Sure. So I think thanks, Ali, and I think this is a great image here to show you, what's going on with this pricing bubble that we've been in. Vacancy rates are up across the board, as you can see, and really those tremendous numbers we saw on the previous page, that happened under what's that middle bar on each of these markets here. So that's when vacancy was hitting lows that it had never seen before ever in the history of the industrial market. So you're talking about vacancy rates getting close to 1% in Southern California, and very low in a number of other markets. So that really corresponded to creating this bubble of sorts where landlords could ask whatever they wanted for a limited amount of space. And there was only so much that tenants could push back on. And this was a really unprecedented market. But what's happening now? I mean, you could really see it illustrated if you dive into that second market there, LAOC, Inland Empire. So this is the greater Los Angeles market, really been a first mover. So that was 3%, 3.6% vacancy pre-COVID. And at peak of the market, that was 1.5% vacancy for that whole region, but it was a little bit, lower in certain pockets there. And now that went from 1.5 to 6.3%. It's actually nationally the steepest uptick in vacancy that we've ever seen. It's not the highest vacancy rate that we've ever seen by any stretch, but it is significant that change has happened in such a short period of time. And at Savills in North America, really representing tenants, they are our core client base. And all of their costs are going up. There's the real estate cost, but also outside of that, they're paying more for their workforce, more for all of the inputs into whatever their process is. And rent is a cost where they're noticing, like we all are, the market has softened up, and they're pushing back on this now. And this is what's been happening on the ground, especially in the LA region, which is a market that really saw vacancy start to go up first. So it's a little bit ahead of the others. And in terms of rents moving, it's really the level is important, but also the change in vacancy. So it's not conducive to raise rents in an environment where the market is loosening. And if you look historically back at the history of markets, that's what you'll find.
Yep, that makes a lot of sense. And it's interesting since we've updated this data to see how much things have changed in terms of vacancy just in the past 3 months. So let's dig in a little bit more into the greater LA market that we're calling it. So that includes Los Angeles County, Orange County, Inland Empire, and Ventura County. So we chose to focus on this because this is really where we started to see the shift in things, and it's been the nation's outperformer. It's had the fastest rent growth, did have the lowest vacancy, and now we're seeing this moderation. So we want to dig in deeper to what are all of the parts of the deal that have changed in this most recent reset period. So here we've defined the market kind of into 3 distinct parts. The before times, which we'll call 2019, peak market, which occurred sometime 2022 to early 2023, and now from the second half of 2023 to the first quarter of 2024, which we're defining as kind of a period of reset. So here we're focusing on bulk transactions. So that's transactions of more than 100K, which is where we've seen the most kind of change in market dynamics. So some of the most interesting things you'll see on this slide is how term lengths have come down. They were peaked at almost 70 months in the peak period. Now they're come down to 64 months. You can also see that effective rents have come down, but also maybe a bit more interestingly, starting rents have also come down. So Mark and I found this notable because it means that landlords have been negotiating a little bit more on even the face rent of the deal, as well as concessions. And one of the big things, which we'll talk about a little bit later, we got some questions about, was the free rent period. So free rent, the amount of free months has come up, but also because term lengths are shorter, because tenants either want more flexibility and or landlords are okay with a shorter term length because they believe this is a brief market correction and they want the ability to reprice and get a new tenant at a later date. You'll see that the free rent ratio, the portion of the term that a tenant is receiving as free rent, has come up significantly to 3.6% of the average term. So, but there's one thing where we haven't seen as much movement, and that's annual lease escalations. And so, Mark, can you fill us in on kind of what we've been seeing there and why that may
Yeah.
not be shifting?
Yeah, definitely. So, I mean, a lot of what Ali's saying, something we found interesting in the report, why we decided to work on this topic. It is, interesting to see that starting rent come down. That's something we had seen in the field and were able to verify with data. But on the escalations, that's been something that has been stickier. So far, it's something that landlords have wanted to hold on to. I think it is very notable. That is starting to come down a little bit. So when we first published this report for that greater Los Angeles bulk, the average escalation for the leases signed in our reset period, which was since mid 23, that was 3.9. Now it's ticked down a little bit to 3.8. Now at the same time, free rent has basically doubled from even pre-COVID period. So very different, but so it's starting to come down a little bit, but it's been something that's much stickier. And yeah, we're starting to see that even change a little bit, but I think really, we can get more into it later, but definitely speaks to expectations for longer term, rent growth not going away, inflation picture, different than certainly 4 years ago.
Yep.
Looking forward, and then I think it tells us a little bit something about really the essence of a negotiation, which is what a comp is what our landlord's willing to give up, what our tenants willing to give up, what might matter a little bit more to a landlord than a tenant, and I think that really comes out in that table, which I really appreciate on the last page.
Excellent. Well, that's the highlights of our report. Of course, we could talk way more about that, but we wanted to fill everyone in on the latest data and the high notes. So with that, I'll turn it back to Jacob and dig into the submitted questions that we got. Back to you, Jacob.
All right. Thank you, Ali and Mark, for that insight. Let's get to those questions. The first set deals with particulars of leasing trends that you covered in your report. So let's dig in. Let's see. The first one is for Ali. Ali, how are leases more favorable to the tenant in terms of concessions, lease terms, base rent, etc.?
Yeah, I can definitely answer that. So I think the best way to kind of demonstrate that is looking at the spread of effective rents over starting rents. So you'll see here that effective rents had a wider gap over starting rents during that peak period. So this means that because free months were lower, starting rents were higher, escalations were higher, the actual effective rent of a deal was higher than a starting rent, but that's shifted recently, so it's narrowing back to where it was pre-COVID, though not quite there yet. You could see that it reached 8%, nearly 8% during the peak market period, but now it's gone back to just below 5% in this reset period. So that's showing that tenants are getting higher shares of free rent, concessions, and also, possibly a slightly lower escalation, as we talked about. So things are shifting slightly back to tenant in terms of, negotiating power, though not yet back to where we were before the most recent growth period.
Okay. The next question is for both Ali and Mark. So I want to get both your takes on this. Why are escalations remaining elevated, and how much do they differ across major markets? Ali, why don't you start?
Sure. So escalations do differ a little bit by major market. So here we're looking at all transactions over 10,000 square feet. And again, we're looking in those three key periods: 2019, the peak period, and this most recent reset period. So you could see that in the pre-COVID period, it was largely around 3%. Actually, it's interesting that Greater LA was just above 3%. But you can see now things have changed a little bit. Basically, all the markets that we covered, 8 major markets, are well above 3% still. But you can also see that Greater LA ranks third in terms of highest. Interestingly, Houston had the lowest in the pre-COVID period, but has had the greatest increase to this most recent reset period. So really, we're seeing that this is kind of ongoing and not changing as much as we previously said. So Mark, why do you think a landlord, might be willing to still hold faster to higher escalations across these markets?
Well, first off, this table is great. It's great seeing all this nuance on different markets. So that this is a new one, and really, wow, it's impressive. We not only to see Greater LA, but to see what that increase has been in places like Houston. But to answer your question again, I gave you the preamble before, but it's really this negotiation, and number one has to do with inflation expectations, rent growth expectations over the long term. I mean, landlords are going to hold on to whatever they can right now. Tenants are certainly pushing back on everything, as much as they can. But it's more about what's maybe worth a little bit more to the landlord right now. But certainly both parties have the expectation for higher inflation than they did 4 years ago, higher long-term rent growth. And then again, there's different perspectives. I mean, the landlord's focused on presumably on their IRR, which is going to be influenced heavily by the escalation of the lease. Tenant may be in a position where having more near-term cash due to free rent is beneficial for their near-term finances. If it's currently a tough period in terms of macro economy. So that's every deal is different, but on average, this is what's going on. But it is notable; it's starting to pick down a little bit. When I was presenting some of this data to IMC, which is a trade association specific for end users of industrial real estate, that was one of the key audience questions that I had was, when can we start pushing back on escalation? So you can see where their heads are at. It'll be interesting to see what happens, but I do expect it not to return to where it was, just given that the world has changed in terms of inflation and the long-term rent growth outlook. I know this whole report has a bit of a negative connotation to it, but I mean, I can't stress enough, this is a temporary reset, and that we're certainly not expecting things to go back to the way they are. At the same time, it's unrealistic to expect that rent growth is going to continue at its recent pace when vacancies, the highest it's been in quite a while.
Yeah, exactly. Infinite growth is not possible.
Rents only go up. That's not true.
All right. Mark, this one is for you. It was a great report, but I've got to ask you, why did you focus on LA, Inland Empire in your report? And can you explain why LA and Inland Empire rents and demand have softened despite the market's robustness in recent years?
Yeah, so I think I will dissect this a few different questions in this one question, I think. First, I mean, obviously we focused on this market given its importance. It is the greatest cluster, largest cluster of industrial space in the US. It also is a market that tends to be a bit of a first mover. So 40%, a little bit less now. It's been going down with the decoupling from China, but 40% or a little less of our imports are coming through ports of LA and Long Beach. So it's sensitive to changes in the consumer markets. There's also been there were also the port issues, and that has an echo effect. This is looking back into 2022 even, but real estate, tends to kind of follow what's going on in those leading indicators. So it was the first market where we really started to see demand weaken or normalize. There's different terms that are thrown out there, but certainly the anomaly of 2021 absorption has come down to earth. That happened, really first in this market. So I've seen people throw out the words, was this the canary in the coal mine? I think there's arguments that it is. There's arguments that has somewhat unique challenges to it as well. And those unique challenges would be, there's out migration from the greater Los Angeles area. So there's the demographic trends that are a bit negative. There are some policies locally that are not necessarily supportive of business growth, including EV truck mandates has been a big topic. So and that, of course, is an expensive market. And it's also missing a lot of the tailwinds that you might find in a Georgia or a Texas that has all of this growth of business and population. So that's on the demand side, but this is supply and demand. And on the supply side, the Inland Empire, really where all of the new construction for this region is concentrated, had an incredible amount of new supply hitting at the same time that demand was weakening. And it happened first here. So this is really why we analyze this market. It's so big that there were enough transactions to really talk about a large trend going on. And then there were transactions that happened earlier. So really a key market to focus on, and still an open question about how much what's happening, which is clearly happening in this market, is going to happen in the next market. So that's something that we talk about in the report, and I think is still somewhat of an open question.
Great. All right. Next question it's another one for both of you. Is there more market softness for warehouses versus smaller industrial, such as those properties that are smaller than, say, 100,000 square feet? And, given what you said, does that mean, 1 million square foot warehouses are sitting vacant for longer?
Yeah, so I can take the first part of this. So I can speak to what's been happening with kind of effective rents and concessions. And by the way, we just got a question about what are the sources for everything that we're talking about here, which is a great question. Mm-hmm. So in general, when we're speaking to effective rents, concessions, escalations, the source of that is CompStak's data. And where vacancy, any construction figures are mentioned, in general, that's Savills data, but happy to answer more questions about that. So returning to bulk warehouses, we pulled some data comparing, transactions of 100,000 square feet versus those in the range of 10 to 100K. Obviously, there's lots of nuances with, looking at this. There's some market differences, and this is just data talking about greater LA. But we thought it was interesting that, we have seen more of a effective rent decline in that larger bulk transaction size, whereas actually in the 10 to 100K, things are plateauing, but there hasn't been a decline. That being said, there are still users that are seeking, massive spaces. I know Mark and I talked about there's actually was a 1 million square foot Amazon deal that closed in the greater LA market, 2 of them in the greater LA market. So it's not that no one is taking, large spaces. It's just that there's been a bit more softness when you are analyzing it this way. And, another way to look at it is to break out the concessions by those same size thresholds. So free rent ratio, which again is the portion of the lease term the tenant is getting as a free rent period, has increased substantially more for transactions of 100K and larger. And this also speaks to the decline in lease term that we've seen for those big sizes, whereas it's the tenant feeling they want more flexibility, or a landlord feeling like they want more flexibility to, release later on. We've seen those lease term lengths come down. Since Mark is the expert on, tracking kind of the vacancy in these markets, like, have you seen any differences there in terms of like size warehouses or spaces, Mark?
Yeah, so that's certainly been the most popular question I've gotten recently. There's a lot of
Yeah.
analysis going on right now by investors, particularly trying to identify where the softness and weakness is by size. I will say that overall, if you're looking at all markets, that there's more softness in larger size segments. So if I'm making a very general statement, 2 to 3 percentage points higher vacancy for buildings over 500,000 square feet, and then when you get to the sub 200, a little bit tighter. Now, I would heavily caveat this as a moving target right now, and you really have to look at this market by market, and then it's changing pretty quickly. So this is where you really have to have good partners with data and analysis. And we will be publishing next week Savills State of the U.S. Market. So definitely follow Savills on LinkedIn and get that report, because we will be showing a vacancy rate by size segment per market. But I can give you a little bit of a high level. So overall, yeah, 2 to 3% higher vacancy in the larger segments. However, if we're talking about Greater LA, Inland Empire right now, it's almost let me break it down for you there. So you mentioned those two Amazon million-square-foot plus deals. They're in our Inland Empire report for the first quarter. So Amazon taking down two massive boxes, and there's only a limited amount of spaces in that huge category, Class A, right? So vacancy is actually the lowest in the IE right now, in the 500 plus, and especially in the 750 a million plus. So that's the lowest vacancy segment. 200,000 to 500,000 right now in the IE, the weakest segment by far. And then it's a little bit stronger below that, but not quite as tight as the 500 and 750 plus. So it's kind of confusing. You really have to it's hard to overgeneralize it, but again, broad strokes, larger buildings are seeing higher vacancy across the country with nuances by market. And why is this? It's really based on what we've built. So there's, for a variety of reasons, especially in terms of spec development, it has made sense to build larger boxes. I mean, there's a tenant demand story there too, but it's also, I think, a bit capital markets driven to have a larger scale for investing in industrial. But there's been a tenant requirement issue there too. So we've perhaps overbuilt in the short term in that range, and there's been very little development under 100,000 square feet, or especially like multi-tenant buildings that have smaller spaces. So that's some of what you're seeing going on now. But again, if I haven't emphasized enough, there's exceptions, and this is flip-flopped, and we have a great page on this in our report coming out where you can really see submarkets. It's this way, and then the other market is the opposite way, and it's changing.
Yeah, that makes a lot of sense. Thanks for the context and the disclaimers, Mark. Next question.
All right. We got a lot of questions about the economy, other factors that are impacting the industrial market, whether those be headwinds or tailwinds. So I'd like to take a look at those now. So has home delivery and online retail sales reached its peak, and will it now stabilize for the next 5 to 10 years? Mark, what do you think?
Well, no. So I don't think it's reached its peak by any stretch. And I honestly think this is somewhat underreported news. You can see the chart there. Everyone knows about the COVID e-commerce bump and then the back down to earth. But what has, I think, been underreported is, over the last 18 to 24 months, the e-commerce penetration rate is what we would call the share of total retail sales has gone up by a full percentage point. And if you drew a straight line through from pre-COVID to now, you're seeing, really an acceleration of e-commerce if you kind of just forget about that COVID blip and talk about, just the normal years. So, I mean, why is there still runway? One argument is that is a good thesis, is that there's a generational and demographic story here, that there are studies that we've put into some of our reports that younger generations prefer shopping, especially buying larger purchases either online or on their phone in a way that their parents may not feel comfortable with. So it just, there's an aging of the population that's going to be a tailwind for e-commerce, and that has years, at least a decade or more to go for that. There's also tech advancements that is making it better to shop online. We've seen the supply chain advancements over the past 10, 15 years. Like if you can get something the next day or two, I'll buy it. But if I got to wait 2 or 3 weeks like we had to in 2012, it's a lot less appealing. And there's things like, in terms of tech advancements, things like, the metaverse is kind of a buzzword, but being able to try on clothing virtually, or I don't know if anyone has purchased furniture recently. A lot of the furniture stores online, like Wayfair, will have envision this furniture in your house, and it's pretty awesome. I've used that, but that's going to keep, I believe that's going to keep happening and making it really kind of closing a gap experience-wise between what you can get in retail. I don't think brick and mortar retail is going away, but suffice it to say, there's a lot of runway. And I think the proof is in the pudding. And we mentioned those 2 Amazon deals in the Inland Empire. I mean, those are just, kind of just examples of recent transactions. But to contextualize that, we track at Savills Amazon's net absorption effectively, and this will be in our report next week. So Amazon's on track to absorb another 40 million square feet this year, and that's not just a projection. That's based on signed leases recently and what they're going to move into by the end of the year. So that's effectively Amazon growing its footprint by 9% this year. And as we all know, they already have a ton of space in the US. They've actually never contracted like year over year, even though there was all those stories about Amazon putting sublease space on the market. And 24 is shaping up to perhaps be Amazon's, biggest growth year outside of 2020 and 2021, which were a bit of anomalies. So right now, that 40 million square foot absorption for Amazon will exceed the rate they were growing in 2019, for example. So, and they tend to be a first mover, right? We saw even during 2020, before we saw all the other occupiers starting to expand, Amazon, I remember a point in 2020 where it was like, oh, overnight, Amazon had leases out on every 100,000 square foot plus availability in northern New Jersey. And that happened. I remember that period, and it was like, wow, something is clearly going on. But at first, the conversation was, is this just Amazon? But then, sure enough, it really, they were a little bit ahead of the curve there. So reason to be optimistic.
All right. Thank you for that, Mark. Allie, I want to get into talking about port volumes with you for just a minute. Are port volumes returning to where they were historically, for LA and Long Beach? And do you expect any impact from the Panama Canal drought?
Yeah, this is a good question, especially in the context of our focus on the greater LA market. So I always find this data so interesting to track. A lot of the story for, last year and a little bit of 2022 was things shifting to the East Coast because various issues with the port on the West Coast, and that, New York and New Jersey actually outpaced volume on the West Coast for a few months there. But things are shifting back to where they've been historically. And actually, Mark pointed this out to us, is that the first quarter of 2024, the combined TEU volume for Long Beach and Los Angeles is up 23% from this quarter last year. So, that's a pretty good indicator. What's going on in, the Panama Canal, of course, is just like one of, many, geopolitical challenges that may be affecting logistics worldwide. But I think the drought is impacting how people are deciding to ship things. I just read recently Prologis's, earnings call earlier this year, going over 2023. They noted that that was going to be a bit of a tailwind for the West Coast, that, fewer ships being allowed through the Panama Canal would mean that more might be coming to the West Coast instead of making that transition through the Panama Canal. So yeah, I think this could be a leading indicator of some uptick in demand for this market in the near term. And of course, that has a lot to do with how much, supply will be available. But, that could be something of a positive for the West Coast market.
Okay, I'd like to talk construction for a minute now, and this one's from Mark. Average U.S. quarterly industrial construction starts are expected to drop to less than 50 million square feet this year from over 100 million square feet in 2022. This is due primarily to high interest rates, less robust lending environment, and lower demand. Mark, what's happening with the deliveries and starts, and how's that impacting supply?
Yeah, so supply is so important for rent growth, especially long-term rent growth, which is obviously the topic of this webinar on the reset. When I worked in investment strategy for a global investment manager, that is really what we spent most of our time on the industrial side, is analyzing what markets had the potential for oversupply and development. So yes, in the short term, that's reason why this reset is really temporary. Construction starts are down 70% from their peak, just about 18 months ago. There's still 500 million square feet under construction right now. So that sounds low compared to only last year. But other than that, we still have some time, both in terms of what's coming, although the pipeline's been shrinking. The buildings that have delivered are largely sitting available still, and because the pre-leasing rates have shrunk quite a bit, and then there's still all of this space underway. So that's what we're looking at in terms of that risk of rents. Was there another part of that question, Jacob? I think that this was kind of a multi-part question that I may have lost some element of.
Yeah, it's all right. Really, it just wanted to get your take on how interest rates and the lending environment is also sort of impacting supply.
Yeah. Oh, I think the key point here that I failed to address yet is like, when will this might increase again? And that's a great question that is a bit hard to answer. A few things going on. Rents, despite the topic of this report, right? Rents aren't going back to 2019, so there's still elevated rents. And I'm thinking like, from a development, putting my developer hat on, you still have elevated rents, but interest rates are higher, so cost of capital is higher. Construction costs have not really come back down to where they were, so still elevated construction costs. land prices may be the one thing that might be a bit more attractive right now. We've tracked a pretty substantial decline in industrial land values, which makes sense with less new development starting. So at some point, it's going to largely pencil out again. I mean, there's still new construction starts. It's leading more build to suit than spec. But we're still seeing spec buildings go up at a much lower rate. So this isn't like 2010 where nobody could get capital, but it's certainly taking longer. It's harder. It's not a one size fits all either. But broadly, we expect it to remain lower for a while. But I think it's a great question. If the macro improves and maybe this reset isn't is kind of is less than what we anticipate, then perhaps the flip side of that coin is the supply is going to come back a little bit sooner. But at some point, it's going to pencil out again. But in the meantime, expect a little bit more build to suits and construction to remain a little bit moderated. But it's hard to think that far ahead right now because we have to see what happens with this space that we're dealing with right now coming online. And I imagine that will impact it to a certain extent. Also see the community opposition to warehouse development question. That's super interesting one. Allie and I actually both studied urban planning, so we've talked about that. So it's something that we think about for sure. And I live in New Jersey, which has been a state that's seeing a lot of community opposition given its dense population and how much warehouse development's happening. Same thing's happening in greater LA area, especially a lot of the Inland Empire cities. This is a supply constraint. Wouldn't say it's totally new, but it's definitely picked up a lot of steam. You'll see signs like no more warehouses in parts of New Jersey, California. I imagine this is going to other states as well. It's a reason to be expect that markets that have land constraints that are densely developed regions like greater Los Angeles are over the long term going to perhaps bounce back sooner. So maybe they reset sooner, but maybe they bounce back sooner because these supply constraints and this being one of them, just the political opposition to warehousing is something that's going to weigh on supply for the foreseeable future in those type of markets and really going to influence them to see landlords be able to raise rents over the long term. But it's an interesting one. I mean, also just we find ourselves kind of in the middle of this argument. I would argue that a lot of warehousing is not as noxious a use as maybe it's anticipate. If people are picturing smokestacks and things like that going next to residential, obviously a Class A distribution center is nothing like that, and often the traffic is lower than what you see in a retail center or something else being built. Also, I mean, they are delivering essential goods to households that are near to them. So definitely a very, very interesting issue, one that is a reason to think again, these densely developed markets. This is another thing that's going to really keep supply in check over the long term in those key locations. But this isn't happening quite everywhere, and certainly there's plenty of markets which will I think we're talking about soon that have plenty of developable land.
Yeah, that's interesting. Well, we're nearing the last set of questions that we received, and they're looking to the future. They deal with how much rental growth we can expect, and what markets are looking better, looking worse off. So let's take a look at those. All right, so this question is also from Mark. Mark, will 2024 net absorption be more or less than 2023, and why?
We're forecasting it at Savills research to be less than 2023. That's that seems to be not not an outlier in terms of our competitors. We're really, it's a tough thing to forecast right now, but we're, really looking at the macro of retail sales in recent months being a little bit weaker, and expectations from leading economists around that, which is, again, consumer spending, number one driver of industrial demand. We're still kind of tinkering with our final forecast, that our last update of forecast, which will be out in our report next week, but something of the order of magnitude of 20%, give or take, lower than 2023 is where it seems like we're going to end up. Tenants are still cautious. It's an election year, but as we've highlighted throughout this, there are definitely green shoots for the market. We talked about the ports of LA Long Beach rebounding, Amazon starting to get more active, which is very interesting. Also, we've seen a strong uptick in venture capital funding for advanced manufacturing, which is a whole nother category of demand we haven't really been talking about. So I think that's going to more translate into 2025 absorption. I mean, keep in mind, it's an indicator that's based on, that's a little bit lagging what's going on, in the market by the time a tenant occupies the space. There's a bit of a gap there. So I think those green shoots are going to be more of a 2025 boost. But suffice it to say, I would expect 2024 is going to be lower. And we saw a fairly weak first quarter. So that is this definitely proving to be true so far.
Got it. Okay. Well, thank you, Mark. This next question is for both you and Allie. And that is, what are the markets with the most rental growth expected in 2024 on through 2025? And what about the least? Allie, why don't you start, and then we'll let Mark finish.
Sure. So, pardon the pun, but I guess this is the $1 million question. But yeah, everyone wants to know, based on what's happening, what are the markets still where we could see growth in the near term, and where are the markets that are going to go down further? So I would say that that's sort of the reason we undertook this report, but we wanted to come up with kind of a framework for how to think about this. There's many things that could impact the direction things go, and that has a lot to do with what happens with interest rates and the outlook for the economy. And again, we looked at the greater LA market because we saw it grown so much and it has more to fall. And we want to think about, well, based on what's happened there, what is a way to think about what other markets might have future rent declines? So basically what you're seeing here is we thought markets that have seen greater effective rental growth from the fourth quarter of 2019 to now the first quarter of 2024, and then plotting that against the recent increase in vacancy. And you can see that we've kind of developed a risk spectrum and a framework. So I would not call this a forecast for where there might be higher risk or lower risk. So Los Angeles, OC Inland Empire figures highly on the higher risk, as well as markets like Phoenix. There's been a lot of construction, and then Atlanta. And then Mark, what do you think about markets where there's lower risk? Can you talk about sort of the left half of the chart where there might be sort of lower risk according to our framework?
I think framework's the right way to think about it, Allie, for sure. And I just look at this chart as these, there's all these little bubbles, right, going on, and we're kind of assessing which bubbles are the most fragile and what makes a bubble fragile, how big it is, right? So, I mean, the bigger you blow up a bubble, and then also like how much, you're pricking it, right? So I think that's where you're seeing this lower side of the spectrum of Houston didn't see the type of effective rent growth that you saw in the markets on the other, on the upper right there. And at the same time, vacancy hasn't gone up that much in that market, relative to other markets from either its peak or even pre-COVID. So you're just talking about not much of a bubble, and then not a lot of pressure on it either. So we expect markets like Houston and Chicago to be a little bit more resilient. And again, just remember, this is all a kind of a short-term outlook. We're not really assessing 10-year rent growth or anything like that. That would be a completely different framework. This is just about what's the fragility of rents across markets for the next year, especially, is how I look at this.
Yeah, I think that's a great point, Mark. And we should mention, we've been talking a lot about LA, OC, Inland Empire, but we've also seen some recent rent declines in the Philadelphia Central, PA market. Those have kind of already happened. So that's sort of why it's a little bit lower for future rent declines. But yeah, this is kind of a framework for thinking about it, what might happen going forward. Back to you, Jacob.
Thanks, Allie. Thanks, Mark. Let's see. This one is a question for Mark. So I think you may have mentioned, some population outflows. And so I kind of want to get your take on relationship demographics. Markets like Phoenix and Dallas-Fort Worth, they came up as higher risk for rental declines, but those are also markets with high population growth. So Mark, how do you reconcile those two things?
Thanks, Jacob. Yes, I think this is a great question. Again, remind everyone, this is really a framework for the relatively short-term risk for effective rents specifically. So there are other factors going into where you're investing. If it's an investor question, I would say that it is that the absorption in terms of and demand is baked into the recent rise in vacancy. So I mean, certainly if demand were exceeding supply in Phoenix and Dallas right now, you wouldn't see this some of the highest spikes in vacancy across the country. So that would be my counter argument, that while demand is strong, it's not going to counterbalance what are the two largest construction pipelines in the market right now. And that's just not going to create an environment where you can push rents on the margin. Now there's pockets within every market that might be stronger, and Dallas is a big place, but we're talking on on the whole. So yeah, we're definitely not bearish on leasing demand for Phoenix or Dallas right now. I agree with pretty much everyone on the tailwinds for those markets. But you can't ignore supply for rents, right? So if that's what we're talking about, ability of landlords to negotiate continued high rents and other deal terms, that's going to be a challenge right now. There's over 10% vacancy in both of those markets. Phoenix particularly is a lot smaller than Dallas. So to see the amount of supply that's come on there, Phoenix inventory has grown by 20%, in the last 2 years, which is crazy to think about. I imagine if you were living in a city, and in 2 years they grew the number of houses and apartments by 20%. So it's going to take some time to work through that demand. And then a lot of the positive, tailwinds. There was a question I saw come in about build to suit versus spec development as well. If we're talking about the manufacturing investments if we're talking about chip fabs that are being built in Phoenix, a lot of them are build to suits. So it's not necessarily going to make a dent in what is a spec distribution pipeline or inventory that's recently built and sitting on the market now. There's knock-on effects and suppliers moving in and all of that. But for the near term, I think being above 10% vacancy in Dallas and Phoenix, that is not an environment that's going to be conducive to pushing rents. Now, we're not saying that means there's going to be a collapse, right? But that is why they are where they are in our spectrum, and I will definitely defend that.
Awesome. Thanks for all that context, Mark. Yeah, it definitely makes sense about Phoenix and Dallas-Fort Worth, where they're just building more and they probably will continue to build more in the future. They're higher growth markets. I was just in Phoenix. They're still building a lot of apartments, but still there's kind of a limit to future rent growth, possibly more in those types of markets. So with that, we are almost perfectly at time. I want to share our contact information. Thank you, Jacob, for moderating, and thank you very much to Mark Russo for doing this report with us, and to Savills for participating. If you have any question, you can reach out to either of us at these LinkedIn addresses. I wanted to mention Mark's report, which you mentioned earlier. In the webinar, their State of Industrial report will be released next week, and also CompStak will be putting out a industrial report closer to the end of May, so please look out for that. We will share the recording and the slides, and thank you everyone for joining.
Thank you.